Okay, so in this video, we'll be talking about investment companies, and we have here an article from Investopedia. Okay, so for the definition of an investment company is a corporation or trust engaged in the business of investing the pooled capital of investors in financial securities. This is most often done either through a closed-end fund or an open fund, also referred to as a mutual fund. Okay, so here in the Philippines, most corporations are registered as, most investment companies are registered as corporations with the SEC, and then of course they also needed to acquire a certificate of authority from the BSP since they are a non-bank financial institution. Okay, and then with regards to the services that they offer, so of course investment types, so they also have the so-called closed-end fund and an open-end fund. Open-end fund, also known as the mutual fund. All right. An investment company is also known as fund company, fund sponsor. They often partner with third-party distributors to sell mutual funds. Okay, so before, when banks are not allowed to offer investment products, so they do partner with investment companies, and that's how they are able to offer investment products to their existing clientele, right? But nowadays, there are, I think, only only one type of bank that are allowed to also provide their own investment services, which is the universal bank. All right, since they are a universal bank, so they can offer any type of financial service or product, including investments. Okay, other types of banks, they are not allowed to offer investment services or investment products. Understanding an investment company. So investment companies are business entities, both privately and publicly owned, that manage, sell, and market funds to the public. Okay, so you have your privately owned, and then you have your publicly owned, or those that are traded in the stock market. Okay, so what they do is they manage, they sell, and market funds to the public. So normally they do engage in acquiring bonds or stocks of existing companies as well, depending on their assessment. Then which of these companies would be profitable in the future, which of these bonds offer the highest rates of interest. Normally bonds are pretty safe types of investments, but they do have lower interest rates, or low risk and then low return compared to stocks, of course. And so essentially, when you are trying to acquire or invest in bonds, you would like to get the one with the highest interest rate, right? And then when it comes to stocks, of course, high risk, high return, and there's also the possibility of losses. It's not only about profit, there's also the possibility that when the market goes down, the economy is doing not well, then the investment could possibly incur losses. All right. So those are mainly the two types of investment that these companies put their funds on, or the money or fund that they are managing for the benefit of their customers or clientele. All right. The main business of an investment company is to hold and manage securities for investment purposes, but they typically offer investors a variety of funds and investment services, which include portfolio management, record keeping, custodial, legal, accounting, and tax management services, all in relation to their investments, right? So portfolio management, so let's say people, you have these people, right? Individuals interested in investing, so we call them investors. So they have money, they go to an investment company, and they would like to acquire investment services. So portfolio management, this is when you have a lot of different types of investments, right? So portfolio is, let's say, a group of investments. So it could be combination of bonds, and then a combination of bonds and stocks, and then of course these different bonds and stocks could be from different industries, right? Excuse me. And then you have your record keeping as well. Of course, you have your portfolio management, and you have to keep track of the records, the buy and sell, and then the earnings of these investments. Okay, custodial, so essentially the investment company would manage the fund, so they also have the custody, okay, of the fund that would be needed for these investment activities. Okay, so you also have your legal, accounting, and tax management services. So if there, you need contracts for, when you want to put money into a certain company, and of course there are certain contracts, or ownership, certificate of ownership, or certificate of shares. Okay, so you have your legal aspect there, and then accounting and tax management services whenever you receive what do you call this, earnings or that dividends. So there are corresponding accounting and tax consequences. Okay, so they could also provide that service. So normally for these investors, they just put the money and let the investment company do all the work, just inform the investors of what already happened, where the money were put into, what are the status of these companies that have been invested in, the records, the balances, the aspect of accounting and taxes. Okay, and then normally they do provide like updates on a monthly basis, and then they also provide an annual report of all your portfolio. Okay. An investment company can be a corporation, partnership, business trust, or limited liability company. So this is in the US, but here in the Philippines, we have partnership or corporation, but I think they are better off classified as corporations, right? So what they do is they pool money from investors on a collective basis, and then the money pooled is invested. The investors share any profits and losses incurred by the company according to each investor's interest in the company. Okay, for example, assume an investment company pooled and invested 10 million from a number of clients who represent the fund company's shareholders. A client that contributed 1 million out of the 10 million will have a vested interest of 10% in the company, which would also translate to any losses or profit earned. So let's say they earned 1 million, so 10% of that would go to this particular person who holds 10% in the company. So for the other investors, depending on your percentage of interest in the company, so that would also be the percentage of profit that you will receive. But again, investment company does not guarantee that you will be profiting from any of your investments, depending on the market conditions, depending on the state of the various companies that the money have been invested in. So it could result to profit, but it could also result to losses. Okay, so depending on that, profit or loss, if that was either was recorded for a particular year, then all the investors would share a certain percentage of that, depending on their the amount of their interest in the company. Okay. Investment companies are categorized into 3 types. So you have closed-end funds, and then mutual funds, or again, another term for open-end funds, and then you have your unit investment trust, or UITs. Each of these 3 investment companies must register, of course. Units or shares in closed-end funds are typically offered at a discount to their net asset value and are traded on stock exchanges. Okay, essentially what happens is, normally this is what happens in normal mutual funds, right? But of course, closed-end funds, they are not mutual funds, it's for the open-end funds. Okay, so what happens is that they pool the money from the investors, right? And then using this money, they invest this in various companies, either in bonds or in stocks. And then depending on, for example, they started it in 2015. Okay, so over the years, it went through a process, up and down. And then for the current year, the fund is still existing. And you have your new clients, new investors, so they add to the pool. And then their holding or their ownership, or the number of units that they would own from this fund would normally be in accordance with the discounted net asset value of that particular fund. All right. Investment companies, they normally have different types of funds din naman, because it would also depend on the type of investors that they are catering to. Of course, they cannot offer one particular fund for all types of investors, right? So you have a fund suited for conservative investors, you have another fund suited for moderate investors, and then another one for aggressive investors, okay? And sometimes, how do you call this? The person, although is within a certain classification, he can also invest in two different types of funds, okay? So again, the pooling of money. So then if there is a new investor, so the amount that he can purchase or that he can take a share in would depend on the discounted net asset value of that particular fund, right? And then I'm not sure, because this is US setting, but here in the Philippines, they cannot be traded on the stock exchange. The fund itself being managed by an investment company, of course, they are investing it in companies that could be traded on the stock exchanges, right? But the investors, on their part, they cannot, okay? The investment company, which is managing the fund, is the one who's doing the trading on the stock exchange or in the investment directly to these companies. But the investor themselves, they do not have that function, okay? Investors who want to sell shares will sell them to other investors, and the secondary market cannot be done here in the Philippines unless you are, directly participating in the trading in the stock exchange, okay? But through an investment company, not really. Okay, mutual funds, or the open-end funds. So they have a floating number of issued shares and sell or redeem their shares at their current net asset value by selling them back to the fund or the broker acting for the fund. And as investors move their money in and out of the fund expands or contracts respectively. Open-ended funds are often restricted to investing in liquid assets, given that the investment managers have to plan in a way that the fund is able to meet the demands for investors who may want their money back at any time. So I think mutual funds, investors could, come and go. And of course, there are certain conditions naman, like interest payment, like when are you allowed to receive interest payments if you hold the investment for a particular period of time, and if you don't hold the investment for that amount of time, then you would not be receiving the interest, right? And then there are also some sort of withdrawable fees. If you withdraw during this period, the percentage that will be withheld and will be charged on your investment will be this one. After 2 years, this rate. Okay, essentially, the longer you hold the investment with the investment company, the withdrawable fees decreases, right? Because what they really want is to discourage you from withdrawing. That's why during the first few years, the percentage of withdrawable fees are quite high, actually. Okay? But even so, mutual funds, right? Their investments are normally in liquid assets. So when it comes to bonds, probably short-term bonds, like 1 year to 2 years, and then you have your quarterly bonds. And then for the stocks, those are actually liquid because they can be traded within the stock market. All right. Like mutual funds, this is the third one. Unit investment trusts are also redeemable, as units held by the trust can also be sold back to the investment company. So essentially, it's almost the same between these two, right? And even so in the Philippine setting. Investment companies make profits by buying and selling shares, property, bonds, cash, other funds, and other assets. The portfolio that is created using a pool of funds is usually diversified and managed by an expert fund manager who can choose to invest in specific markets, industries, or even unlisted businesses that are at early stages in their development. In return, clients gain access to a wide array of investment products that they normally would not have been able to access. The success of the fund depends on how effective the manager's strategy is. In addition, the investors should be able to save on trading costs since the investment company is able to gain economies of scale in operation, large volume. Okay, and so we have that. What could I add? Okay, investment companies here in the Philippines, of course, that's what also they do. They diversify the portfolio. So they invest in different types of, investments. You have your bonds and stocks. Again, those are the main two. And then you have your property, cash, other funds, and other assets. I think with regards to cash, you can do foreign currency investments, right? And then you have someone to manage that. We call them fund manager. And then normally they do invest in different industries, okay, just to offset the different ways they react and the economy changes, right? So depending on the situation of the economy, some industries would thrive, some industries would suffer. So in a way, you have to invest in different types of industries so that you can offset, okay? Imagine if the investment were put into industries that all suffer during, let's say, the pandemic. So in a way, it would suffer, right? And not only the investment company, but of course the investors as well. That's why, of course, they have to ensure that the investments are diversified in a way that there are investments that would thrive in certain situations, and then there are others that may not thrive or might have to suffer through a certain situation. Okay, and then of course different investment companies, so you have different individuals trying to manage that. So again, it would also depend on the expertise of these fund managers on how well they manage the investment portfolio. And then, of course, different investment companies, some are very strict. They want to protect your money, so they only invest your money in registered companies who already have, a history of years and decades of operation and have been declaring profit year after year. But there are those investment companies that in a way, they do take risks, but they also provide you with an array of more choices and where to put your money on, because they also look at, startups, especially in the tech industry, right? And also in the real estate industry. So sometimes these are not registered with the PSE, but there are a lot of them that are doing well. So some investment companies would also invest in those types of companies, okay, which investors can choose to do so. Okay, so that's it for this video. Again, we've just covered the investment company, the definition, and the nature of their operations. All right, so that's it for this one. Thanks and bye.